The first one they talk about, that's an accrual, and again, this is going to be focusing on I guess we're going to do the revenue side, is we're going to go through and we've done some work, but we haven't billed for it. So in this case, on the bottom of page 107, they talk about accounts receivable. So what we want to do is we want to go through and we want to show that we have an asset. People owe us some money. And so they tell us that we went through and we evaluated when we've done the work, and maybe we've completed the work and sent the bill, and we haven't received payment. Maybe we haven't sent the bill yet, but we've done the work. We have our timesheets. At any event, on October 31st, we go through and we look at this and we say, you know, we really should be paid $200. This is the amount that we've completed work on. We've earned it, and we haven't sent the bill, or if we've sent it, we haven't received it, but it still needs to show up in October as a revenue. But it's not going to show up yet because we haven't generated either a cash item, and if we haven't done an invoice yet, we haven't even generated a bill. If we've sent an invoice, probably when we sent the invoice, we generated account receivable. So this is more likely at the end of the month for jobs that you've worked on but haven't finished and haven't billed for yet. So we have to do an adjusting journal entry here to put it in for the $200 to make sure we get that revenue in October. And the journal entry for that's going to be pretty straightforward. It's going to be accounts receivable, the asset. We need to increase it by 200, and then we want to increase the revenue because we want to show that we've done the work and we're entitled to be paid for it in the future. So service revenue, and that's 200. And if we didn't record this, then what would happen is our assets would be understated and our revenue would be understated because revenue would be too low and that would make income too low. So those are accounts receivable. More likely what you're going to run into is going to be expenses, where we've gone through and we've received a service or received some benefit, but we haven't paid for it. And they talk about the accrued expenses. Again, service has been incurred, but we haven't yet paid for it ourselves. And they talk first off about accrued interest on page 108. So in this case, you go through and you have a loan that you owe the bank, and maybe you aren't going to pay it until several months later. So every month you don't send them a check. This isn't a payment like on our car where we pay every month. Here, we're going to pay it all at the end. Now, one of the things you need to keep in mind if you're doing interest payments is remember how we calculate interest. And the way that we find the amount of interest that we owe is to take the interest times it equals the principal times the annual interest rate times the time period that we're going to be borrowing the money. So in this case, they tell us that we had $5,000 that we had borrowed from the bank. We pay 12% a year for the whole year, but we don't want to record the whole year, we only record 1 month. So we're going to take that times 1/12, and that's going to be basically the same as divided by 12. That tells us that the amount of interest that we owe is $50. But we're not going to pay it until we pay the loan back with the interest later on. So what we need to do now is we need to go through and we need to record that liability. So we have an interest payable account, and doesn't have any value in it now, so we want to show that there's going to be a liability to pay $50, okay? So we have to do an adjusting journal entry end of the month for the $50. And the journal entry for that is going to be to put the $50 into an expense account to show the cost of borrowing the money, so interest expense, $50. And then again, we also want to show the liability being increased. So interest payable, $50. If we didn't do this entry, adjusting entry at the end of the month, then our interest expense would be too low, means our income would be too high, and our liabilities would be too low, so our balance sheet would be off. Another one that's pretty common that you have to record is to pay your employees for their wages, because most companies don't necessarily always just cut off at the end of the month. A lot of companies pay every 2 weeks or different time periods. So the period of time that employees are getting paid and the end of the month that you're doing for the accounting don't always coincide. So on page 109, they talk about accrued salaries and wages. And in this case, they go through and they show you the calendar there where they count up how many days from when the employees were last paid until the end of the month. And those are the days that need to be recorded in that month, because that was the month that they worked, so the expenses belong there. However, it may be several days past the end of the month before they're paid, so you need to split the days between the 2 months. So in this example, they go through and they tell us that we had, what was it, $5,000 people were paid for a 5-day work week. And then they tell us that there are 3 days in October where they work before the end of the month that they haven't been paid, because they aren't going to be paid until the 9th. So what's going to happen is going to look like this. We need to go through, we need to record the obligation, the account payable. So in this case, it's just called salaries and wages payable. And so what happens is we go through and we know on October the 31st we owed some money. We calculated it up and it was $1,200. But they're not going to get paid until later on the 9th. They're going to get paid that $1,200 plus the $800 for the month of November. So the cash isn't going to happen until down here. This is the payment. So we want to show the liability at the end of October. So what we need to do is adjusting journal entry for the $1,200. And the journal entry that we're going to do is going to look like this. It's going to have a debit to salaries and wages expense. To put those expenses in October for those, how many days was that? 1, 2, 3, 4, 5, 6, 7, 8, 9 days? 3 days. 3 days. They counted their own calendar. 3 days. So we're going to go through and we're going to put that in for that $1,200. And then what we're going to do is then we're going to put it into the wages or salary and wages payable account to show that we owe the money. And then later on, when the payment comes out on the 9th, then we'll reduce that payable account. That's why you're going to see, basically, you'll see the debit over here on the payment when the cash comes out. See, what else do we have? Those are probably the major accruals and deferrals you're going to have to worry about. You're going to have to know how to do the journal entry, so you want to go back and practice those. On 111, they have some discussions about errors. When errors occur, you might want to go through and take a look and see how, if you have a problem, they give you some tips there. First of all, you should never have a journal entry for an adjusting journal entry to cash, because that's why we're doing them. There's no cash involved. So if you're putting cash in one of these entries, you probably are making a mistake. The other thing is you should always have one asset account or liability account on one side of the entry, and then one, or you could have several, but also you should have expense or revenue accounts on the other side. So you're always going to affect the balance sheet and the income statement.